All right, hey everyone. Today I'm diving into a few companies that I picked up on Open Insider. So Open Insider is a site I use to basically track insiders that are buying. You don't always get a lot of good signals, but every now and then, every couple of weeks, I just dive in, pick up a bunch of companies across different sectors, and yeah, just try and see what's interesting. Maybe there are companies there that I might be interested in buying, and so that's what I do on a pretty regular basis. So I did this exercise yesterday, and I picked up a bunch of companies that I'd like to dive into, and so that's what I'm going to do in this video, is just walk through these companies. So first up on the list is TUP, Tupperware Brands. I know what you're thinking, like, I never imagined myself I'd actually be looking to potentially invest in Tupperware, but here we are. So just to give you some context, we can see which insiders are buying in Tupperware. So you can see in the past couple of weeks, we've had Fernandez, so that's the CEO, Calero, Richard, Cassandra, Karen, and Patricio all buy into the company, and significant amounts. Like Fernandez, Calero, that guy put in $500,000. Richard, that's another $500,000, and then 50 to 80K, significant, and they all did it on kind of like that same week, that week of the 12th. So very interesting. I definitely want to take enough of a signal to kind of say, all right, you know what, let me check this out, get a feel for how this works. So the process we follow is pretty much standard by now, but I'll walk you through it. Just put in Tupperware up here, and we'd be able to see. Okay, so this is supposed to pull up the peers. Let me just make sure that happens. All right, just wait for that to clear, and then type in again. All right, so this pulls in financial information for the past 20 years, and you can see first thing we do is kind of take a look, get a feel for revenue and how that's behaving. So you can see it kind of peaked around 2014. 2013, 2014 at 2.6 bill, and it's just been decreasing ever since. That's kind of like a red flag, right? I mean, revenue peaked 2014, dropping ever since, including last year. I mean, last year kind of COVID write-off year, but really there was a big drop off between 2018 and 2019, as well as 2017 to 2018. Definitely concerning. Also, take a look at debt relative to revenue. Okay, looks all right. I mean, it's not huge, yeah, it's not huge. 750 mil compared to 1.7 billion, and especially considering that they've actually bought back, they've paid off some debt. So it was 930 last year, or in 2019, should I say. And then this year it's 750. So they are buying back debt. It's not like they're loading onto more debt. So not too worrying. So that's kind of like from a Hellenish perspective. I definitely want to look at interest expense to get a feel for how much is their interest expense relative to total expenses. But it doesn't seem that huge. I mean, you can tell just by looking at this. So from a credit assessment perspective, you can see paid up roughly 200 mil, and they just have 750 left. And you can see that quick ratio is 0.3. That's not great. And quick ratio is just short-term assets minus inventory and divided by short-term liabilities. And cash ratio just takes actual cash. 0.2 cash ratio. I don't like that, but the fact that interest coverage is 5.1, that's kind of okay, But interest coverage is 5.1. So what that means is, like, if they were to take their cash, and I have a note here just kind of describing it, but if you take the operating income that you make and then you divide it by your interest expense, your yearly interest expense, it can cover 5 years. So pretty decent. I mean, it's not great, but it's decent. And then you take cash over interest, that's 3.6. So cash over interest, 3.6, that's good. And cash over interest is 3.6. So if you really needed to pay off everything using the cash that you have available, you'd be able to pay off like 3.6 years before defaulting. And so that's a pretty good indicator. They cut off dividends in 2019. That's definitely a red flag. Dividend cut in 2019, so before COVID, huh? You can't use COVID as an excuse there. There's definitely something going wrong before 2019. I want to figure out what that was. Margins. Okay, so maybe before margins, we can take a look at assets. So assets have been declining pretty consistently as well. Tangible book, from 27 it went down to 23. Okay. All right. Interesting. Maybe they're selling off parts of the business. That could be. Book value is negative. Okay. Negative equity. Negative equity. So your liabilities exceed your assets. So that's what it means. Your liabilities exceed your assets. I don't think you can run a company on negative equity for very long. That's pretty bad. Yeah, it's pretty horrible. It's a red flag if I've ever seen one. So negative equity, and it's been the case for past 4 years. For the past 4 years. Yeah, that's worrisome. That's worrisome. You definitely want to figure out what on earth is going on there to cause that negative book value. Cash, pretty stable. Liquidation common is negative, no surprise there. And dividends were stopped back in 2019. So no dividends since then. Okay, all right. Margins, let's take a look at margins, and you can see, all right, so very thin net income margins, just kind of historically. Gross margins pretty stable. EBITDA margin, bit bouncy, but roughly around that 15% mark. And yeah, operating margins kind of bouncy too. So is net income. I mean, at 8% net income, maybe it's decent, but I don't know. I don't know. It's very bouncy. Like, something went wrong in 2018, 2019, maybe even 2017. Like, you're seeing negative net income margins in 2017. So why on earth negative net income margin in 2017? What happened? Yeah, I definitely want to know what is going on. Like, there's something happening in the business, and I can't figure out what just by looking at the numbers. So need to look into that. Maybe check Seeking Alpha in a bit. But first, let's see. So positive earnings, yeah. I mean, again, net income margins pretty low, but it only dipped negative in 2017. So positive earnings since then. Okay, that's good. That's positive. Free cash flow is positive. That's also good. Very good. You want to have positive free cash flow. Operating cash flow, naturally, that's positive too. Net cash flow, yeah, negative here. I guess that's because they paid back debt, right? They used up the cash they had to pay back debt. And yeah, they didn't pay out a dividend, so that's where it went. Okay. Otherwise, I guess everything looks okay. I mean, return on equity, it's pretty rubbish, huh? It's just been negative sustainably, consistently. So negative ROE past 4 years. I want to figure out what's going on. These are all red flags that should be really concerning. Yeah, so I want to get to the bottom of this, understand what is going on with the business. And once you have answers to this, we can try and figure out what a fair price would be, and you know, whether it's actually worth investing in the company. So to do that, we just go to Seeking Alpha, see what's going on. Tupperware brands. How I missed making 11x in 11 months on Tupperware. what I learned. Okay, not very recent. This was from November 2020. Okay. Low quality earnings. Okay. Now let's check out all of them. You know what? Let's just check out all of them. This is from September. This is November. So this is Jan. Okay, so this is the oldest one. Parabolic. Oh, it actually went up since this article. Major cost cutting the drivers. Okay. Oh, he's short. Bad luck. Didn't work out. Short since 26. Okay, I guess he should have exited before he ended up losing money. All right. I mean, this is all good. This is all good to know, but I want to take a look at the comments. Weak leadership, decline in earnings, weakening dollar. Oh, they have bonds. Wait, is this an MLM? Is Tupperware an MLM? Yeah, that'd be important to know. I mean, I don't invest in MLMs. Yeah. It is an MLM. Okay, all right. I mean, clearly it's an MLM. I'm not going to be investing in MLM. So it seems, from a debt perspective, it seems halal, but it's actually an MLM. And like, normally MLMs have really good financials. This looks pretty crap. Anyway, that covers it for Tupperware. Let's see. Up next, we have Myers. Oh, this is actually one that I've already reviewed. Myers Industries. This is a chemical company. Huh. Did I have this on my stock alerts? Interesting. Let me pull out the financials for this. MYE. All right. Yeah, I do have it on my stock tracker. I was trying to get it at 18.8. Interesting. No. Why am I looking at that? It's at 20.9 now. Okay. Yeah, just beyond. Oh man, look at that. It dropped to roughly 19. Yeah, that would have been nice. That would have been nice at 19. I think I'd be happy with it at 19. Yeah. Oh well. What are you gonna do? It's water under the bridge. Alright, so I've already reviewed that company. I'm not gonna do that again. Cool. Alright, so that's that. And then we have FLXS. Let's see what that's about. FLXS. This is taking a while. Flex Steel Industries. Wow, it went up 6% just yesterday. Whoa, just missed it, huh? It's pretty small cap. Okay. Alright, that's not showing up. Let me clear that. Sometimes that happens. I don't know. Maybe the internet just gets disconnected. It happens. Let's see if that works better the second time. It should work though. I mean, what has shown up? At least the basic information, that should be there. Yeah, it's still loading up the tabs. Weird. Definitely looks like some sort of glitch. Yeah, I'm just gonna refresh this. Just clear that up. That's what happens when you automate too much. You know, it just ends up taking a lot longer than it needs to. Alright, let's clear those. You can see the tabs down here just getting cleared. Alright, there we go. That's gone. So, FLXS. Let's take a look. Come on in. There we go. Alright. Flex Steel. Manufacturer, importer, and online marketer of upholstered and wooden furniture. What? Why is it called Flex Steel if it's wooden furniture? Reclining chairs, sofa beds, bedding units, tables. What? That's so weird. What a strange name. What a strange name. Like, it's got nothing to do with steel. I thought it would be like a steel manufacturer or something. Alright, so a bunch of furniture. Okay, cool. Alright, so, yeah, let's just call it Flex Steel. Let's make a page for that. Let's dive in. So definitely consumer discretionary. This is going to be insider buying. Yeah, let's take a look at the company. So 388 million in revenue, pretty good. I mean, especially considering COVID last year, right? But it dropped up until June and then picked back up. So, all right, that's good. They bought back some shares. That's nice. Debt is minimal. Okay. I mean, just looking at this, like debt 12 versus 388 million revenue, like I would not worry about, from a credit perspective, I would not worry about it at all. Also from a Hanan's perspective, I mean, they're just selling furniture, right? Very low debt, nothing to worry about. All right, so red flags, let's take a look. What are they on? It's $32 in tangible book and assets, so no intangibles, $23 in equity, 4 in cash. Okay, so probably use some of that cash to buy back shares. Liquidation to common is 23, dividends 0.15. Okay. All right, nice. Gross margin 17. EBITDA's margin is negative. What? Okay, that's pretty bad. Whoa, negative net income. Oh man, it just keeps getting worse. Negative net income. Negative operating margin. This is bad. This is bad. Operating margin is negative. Yeah, I suppose. I mean, if EBITDA is negative, it's not going to get much better. Yeah. Yeah, it's pretty bad. Oh, dear me. Looks like it was better at some point. You know, they were at 5%, but this is way before COVID. This is 2018. You started seeing a decline, and then 2019, it just dipped negative. It was so bad. Yeah. 2019, huh? That was a bad year. That was a bad year. And then they had to get debt. They had to take on some debt in 2020. Okay. All right. Margin decline. 2018. So something is going down. This is operating margin income. Yeah, definitely want to figure out what happened there. And then it's gotten worse. I mean, so trailing 12 months, it did get better. So you're saying minus 5%. Okay. I mean, yeah, it's getting better. It's better than minus 7%, right? But still, the beta margin is negative. That's bad. The only positive thing here is that operating cash flow is positive. That's good. That's good. So positive operating cash flow. That's a redeeming quality. I mean, if you have negative operating cash flow, you're in a very bad position. Asset turnover is getting okay. Asset turnover trailing 12 months it went down, so I'm not going to qualify that as a red flag. But yeah, negative return on equity. Oh, that's bad. That was very bad. Cool. All right. So I can imagine like their multiplier is going to be, so they're going to be a multiplier of a beta. Negative 15. It's negative 16 right now. Wow. That's expensive. It's still a fraction of revenue, but yeah, I expected less than 16 times the beta, to be honest. I mean, that's pretty bad. Like, the state is horrible. Like, why on earth? It was down to like 3 times the beta. Look here. 3 and 2 times the beta. Like, why would they be 16 times now? I mean, it went from 2 times to 15 in 6 months. Wow. Okay, so I guess what happened here is people just wrote it off. You know, last year, they were like, okay, that's it. This company's going down. It's just not going to work. It's going under. And then it just bounced back, right? I mean, look at that price difference. It dropped to $12 and then went up to 34. So it was written off. People just thought, okay, you know, it's going bankrupt. Wow. But 16 times the beta, that's generous. Yeah, that's generous. All right, so this kind of got messed up. This is copy of main, B set. Furnishings and fixtures. Okay, I'm going to do a pure comparison towards the end, but what I want to know is I want to get to the bottom of this. Like, you have these red flags. I want to understand what on earth is going on. Oh, sorry, FLXS. Yeah, let's see if we can figure out the story. Jan 28th, okay, pretty recent. So look at both. Yard sale. Flex steel. Yeah, that was a good call. Flex steel is a net with great management. Okay, all right. Pure housing play with 59% upside. Furniture company, all right. Beneficiary of housing market boom. Okay. Okay, so definitely went up since reporting, yeah. Still gone up since. All right. Yeah, I just want to understand why on earth, again, like these two questions. Operating margin declined since 2018. All right, it's a lot of talk, but I really want to understand what on earth happened. Ongoing transformation program. Okay, maybe that's related. So there's some sort of transformation program. All right, so I get the housing market, but I want to understand why it dropped in 2018. Let's see. Gross margins recovered to 20%. Yeah, okay. I mean, it's getting there. Not quite 20%, but yeah. Okay. Yeah, not sure what to make this, but whatever. Let's see if there's more here. Companies move to exit various commercial businesses. Focus on residential completely cannot have been timelier. Okay, that's interesting. That is interesting. Okay, furniture, yeah, okay. So apparently they moved out of hospitality and corporate and then focused on residential. Okay, so they had restructuring expenses that they were paying off. At least past year, huh? $30 million repurchase, okay. All right, so they brought back dividend. Oh, okay. So getting their shipments from China, okay. Okay, all right. Okay, so that's interesting. Maybe I'd want to understand. So the China trade war could have killed their margins because they had to pay 25% surcharge tax on incoming shipments, and it looks like the bulk of their shipments were coming in from Asia. So that would have killed margins. Let's take a look. Okay, so that was in 2018, 2019. Yeah, okay. That would explain. Okay, that could explain this. That could explain this. Definitely could. And then I think they continued up until recently was the so U.S.-China trade war taxes. I don't know if they removed the taxes or not. Okay. Housing starts. Okay. Strong housing market, record backlog. Exit commercial business. Okay. Okay. So apparently, wasn't the tariff issue still ongoing? I wonder if that's going to change with Biden. Oh, here we go. Oh, they're still ongoing. Okay. Okay. Yeah, okay. All right, that makes sense. Yeah, I imagined Biden would remove the tariffs, but it looks like it's still there. Okay. All right, cool. So that's good to know. That kind of explains this, right? Operating margin, net income margin decline due to higher costs, and the higher costs driven primarily by the 25% tax levied on incoming shipments. That'll kill your margins. That's understandable. Negative return on equity for the past 3 years. Again, this is all kind of the same thing, and it's all a result of this U.S.-China trade war and the taxes levied on their existing cost base. And it looks like because they have this, what is it, Mexico? Multiple locations to source furniture. It looks like they're moving to Mexico, and somehow that's going to result in lower tariffs, I assume. No coverage by the street. Okay. All right, let's take a look at comments. Okay. So yeah, they're all pointing at insider buying and how that's a catalyst for stock price, which I agree with, of course. You better be sure that that's not the only thing that you need. You need to have some sort of fundamental change in the business that's going to drive this. So far, the risk appears to be like these tariffs, but I don't know if that's going to go anytime soon. Free cash flow over enterprise value, because in many cases it's a more accurate representation of the value of the firm when stripping out net cash. Okay. All right, let's look at someone else. So this guy, May 2020. Okay. Wow. Look at the return since then. 330%. Wow. It beat 45% on the S&P 500. That's nuts. All right, let's see the comments. May wait until it is a little cheaper. I hope you didn't. Okay, 71% gain just under 2 months. Okay, nice. Good for you. Yeah. Strong cash position, pro shareholder, 2/3 of net current asset value, net stock. Yeah, I've been meaning to read this Benjamin Graham book. Yeah, I'll get to it at some point. Okay. Is he still the CEO? Jerry Dittmer. Okay, so it sounds like this Dittmer guy is the one who decided to transition away from commercial and focus on residential. Good call. All right, so you got some competitors. So that's what we could do now. Okay, so the story checks out. Looks like they're all kind of suffering from this trade war. And also mismanagement, and you had new management come in, this Dittmer guy. New management since 2018, right? Okay, all right. Flex Steel. Yeah, so he's still the CEO. All right, so CEO letters. Okay. When I took over the role of CEO, fully aware that we had serious challenges. Okay, so yeah, 2018, I think he came in. Cool. All right. So he's got the right background. It's a lot of announcements. Yeah, there we go. There it was. There. December 2018. Okay. That's great. Okay, so this makes total sense. New management coming in, changing things about, moved away from, so kind of here, right? At the end of the year, so you can't really count 2018. It's really 2019 that you would start to see some benefit. And obviously, it doesn't happen immediately. It's going to take some time. So 2019, 2020, kind of written off. 2020, obviously, COVID didn't help things, but they are turning things around. Like, you can see that happening here. So it's a pretty compelling story. I can get behind that. Looks like it might have been overlooked. You know, people might have thought, oh, just written it off. But well, yeah, things did get better. It would have been fantastic to buy in this price here, right? 2 times EBITDA, but can't turn back time, right? You're kind of stuck with it. Cool. All right. So last part of this is just doing a comparison between this and a few of its peers to kind of get a sense for what the multiple was like. Okay, 1,100 times EBITDA. That's definitely not industry standard right here. This is B set. It must have ridiculous EBITDA. Okay, it's 0. All right. Wow, this looks horrible. Man, income margins are rubbish too. Yeah, no, definitely better. Flex Steel is definitely doing better than they are. What is this? Casper. Oh, Casper. Okay. Yeah, the bed thing. The mattress thing. Okay. Wow, net income margins are rubbish. Okay. I mean, it's still kind of early. I don't know if it's fair to judge it that way. Bicycles, what does this got anything to do with it? Okay, so they have furniture. But they closed down in 2006. Why am I looking at this? Alright, so Hooker Furniture Corporation. Alright, so 550 from 611, so decline in revenue. Okay, not that much. Alright, let's take a look at net income. Okay, so decent net income, average of 5 if you count out. Yeah, if you count out COVID. Okay. What's the multiple? 36. So 36 times EBITDA. Now, I guess it's understandable, right? What is this? Hoft? Hoft. 36 EBITDA. 37 earnings. Well, currently it's 47. Wow, 47. 47 EBITDA, that's nuts. Oh. Yeah, but 0.7 times earnings. 0.7 times rev. Okay. And 37 times PE. Let's take a look at one more. ETH. It's a nice ticker right there. Ethan Allen. They must be familiar with Ethereum. Alright, so... Okay, decent margins. That's nice. Net income. Alright, so they have some debt, but small compared to revenue. Let's take a look. What multiple are we looking at? Oh! 11 times EBITDA only. And 2 times the revenue. No, 1.3 times the revenue. And 52 times PE. Okay, so I mean, when you compare it to these guys, it doesn't look that expensive. I mean, coming back to here, right? You're talking about 15 times PE. All right, before that, what multiple of EBITDA? 16 times EBITDA. Yeah, I mean, it looked really bad before you considered like the whole CEO situation, changing management, blah, blah. But now, it looks decent. 0.7 times rev. Yeah, looks pretty fairly priced. I like this company. And strong insider buying? I mean, yeah, I can get behind that. Yeah, cigar butt. That was way back then, huh? Wow, it was 0.2 times sales. Quite a bit of expansion there. Wow, highest conviction holding at this time. Good call, Nate. Oh, I'm already following him. Interesting. Yeah, let's see what's going on with this guy. Alright, okay, cool. Agreed on the thesis. Okay, we checked the comments out, and I think it's good. Now, it's just a question of what time's a good time to buy, you know? That's it. That's all this boils down to. So, let's take a look. I'm going to go back to daily. And you can see that currently, okay, RSI is pretty high. It's just been going up past week or so. Yeah, it's at 33. Okay. Is it 55? Yeah, it's roughly 55. Okay, 4 hours. Wow, that's past 60. I don't know. I mean, I'd probably want to buy somewhere at 50, so somewhere at 35, maybe 35. I'm not going to buy here. I'd have to wait. I mean, 6%, it went up 6% yesterday. Yesterday it went up 6%, so I would have bought it like 35-ish. Yeah, 35.5. I can buy 35.5. I can get behind that. I'm not going to buy at this price, not at 38. Okay, cool. Wow, that took a while. Furniture, huh? Interesting. Yeah, that definitely took a while. How long has it been? 11:44, 12:11. Oh, okay. So it took like 25 minutes just reviewing that one company. Because again, it's tricky. Like when you have like a turnaround type company, you kind of need to dig in deep. Like it's a story play, right? Because the numbers, they just look like crap, right? You look at this and you're wondering, what on earth happened? But things were going pretty swimmingly before that fateful year, 2019. That's when you had a management change and all that other stuff. So yeah, it's understandable. Cool. All right. Okay. All right. Cool. That was a nice one. Yeah, I don't always bump into like these turnaround plays. Plus, I mean, check it out. Like, I don't know if I showed you this. The insider buying on here is pretty spectacular. Like, look at that. CFO, COO just picking up stocks like they're candy. Look at that. 250K here, 50K here and there. 8K, 3K. All right. It's pretty good. It's pretty interesting. I like that. I like seeing insider buying. I'm a sucker for insider buying. All right, cool. So, let's see what else. Gosh, how long has it been since I started? I don't know. Yeah, what else? Let's keep going. So, PRMW. So I get into these plays, I don't even know what the company's doing, right? All I see is a ticker, PRMW. All right, what do they do? Beverages, non-alcoholic. Primo Water Corporation, water direct to consumers, water filtration. Company offers bottled water, purified spring bottled water. Okay, all right. Headquartered in Tampa, Florida. PRMW. Whoa, wow, look at that debt. Okay, it's a utility, right? Direct to consumer, yeah. It's a utility though. 1.7 times debt to equity. That's about the limit of what I'm willing to accept. That's right up there on the limit, you know? I just don't like high debt businesses. Plus, I don't think they're halal. So, you know, you want to avoid the businesses that rely on debt. That said, they are dropping their debt. So you can see, like, they went down from 3.5, 3.6, 1.7 debt to equity down to 1.7. And, you know, at their peak, it was 2.2 billion in debt. Now it's 1.6. So past year, yeah, it went up. Understandable. But, wait, what? Why is this? Where's 20 gone? Where's 2020 gone? What is this? You go from 19 straight to 2021? What is this? They changed the year? That's weird. Yeah, you don't normally see that. Okay, so this must have been the data for 2020. But they're just showing it a month late. That's what happened here. All right, so they issued more shares. That's not a good sign. Primo Water Corporation. Yeah, let's just get that name. Primo Water Corporation. All right, let's check it out. So this is a utility. All right, so let's see. Would I consider this halal? All right, so you're looking at 1.7 debt to equity, 1.6 billion over 1.9 billion. Okay. What is their interest expense? So cash over interest is 1.4. How much cash do they have? Cash is 0.7 per share, so 0.74 times 155 million, that's 114 million. And then, so you take that and you divide it by 1.4, so about 81 million interest expense. Okay. Yeah, I mean, I have cash and equivalents right here. I didn't need to look it up. So 115, and then you do 115 over 1.4. Yeah, about 80 million in interest expense. Okay. And what are the... Okay. I mean, 80 million relative to what are their overall expenses? I mean, operating margin is negative 3%. Whoa, what? Negative 3%? Okay. I don't know. I need to look into this just to get a feel for. So, what is it called again? PRMW. Yeah, I want to see what the interest expense is. I don't have a way to do this right here. Which is why I kind of need to look it up manually. All right. Net interest expense is 81. Percentage of revenue, so it's 4% of revenue, and then total expenses. So let me just pick it up from the selected financial data. Oh, come on. Yeah, that's the income statement. So net income, assets, liabilities, so total liabilities. This is the balance sheet. Where's the income statement? Interest expense, other expense, 81. So the vast majority of their expenses. Huh. Yeah. Yeah. Yeah, no. I don't feel comfortable with this. You know, I just don't see it. Like, why am I still looking at Flex Steel? Yeah, I mean, that's the problem, right? I'm looking at those interest expenses, and they seem significant. Like, they are a significant part of the overall expenses. 81 over, you know, a total of roughly 100, so about 80% of your expenses are interest expenses. Yeah, it's excluding cost of sales, which is roughly under 10%. And then you have other expenses. We'll come back to it. Like, I need to look at this closer to get a feel for whether it's halal or not. It looks like it's on the edge. Maybe I'll avoid it just in case. The only redeeming quality is that it's actually decreasing. So they're deleveraging as a business. So yeah, that's the redeeming quality. All right, let's see what they got. So, I mean, look, the cash ratio is rubbish. The interest coverage is actually negative, because I assume they have a negative interest expense, or they have negative operating income. Yeah, they have negative operating margin. Okay, yeah. So that's why it's negative over there. But cash over interest is 1.4, so kind of perilous there. Very, very shaky, murky waters there, which is kind of ironic because it's a water company. PRMW. I want to see the yield on their bonds. PRMW. Nothing. Oh, I thought they had bonds. Okay, so anyway, let's take a look at margins. So margins razor thin. I guess that's kind of typical of utilities. But seriously though, operating margin just 2%. Net income margin is just barely above 0, except for this one-time event here. Okay, operating cash flow is positive. Man, free cash flow is positive. That is good. Okay, positive free cash flow. I like that. So negative net income margin. That's a red. It's definitely a red flag. Negative net income margin. Do they have a dividend? They do. Okay, yeah, they do have a dividend. Looks tiny though. Okay. Positive free cash flow. So that counts for quite a bit, actually, positive free cash flow. That's good to see. Okay, cool. So return on equity is rubbish, but it was decent for a while. Also share. Okay. All right. Okay, cool. Why don't I see the peers? You know, I hate it when that happens. Okay, let's do that again. So, let's see what the story is about. Be wary of long-term debt. And that's exactly what I was saying, right? Debt is really the worrying part here. Yeah, it's actually just slightly above since November. So it's above the S&P 500, okay. Yeah, net income, it's pretty crap. Water delivery sales are generally higher during warmer months. Okay, so they did pretty badly last summer. What is the multiple anyway? And why can't I see the peers? I hate it when this happens. Like I have to manually go in and fix this. This is annoying. I need to get to the bottom of this. Figure out why this is happening. Like it's supposed to load the peers down here at the bottom, and man, like sometimes it just does not work. Yeah. Okay. Yeah, look at that, it dropped just a month ago. It dropped to like 14. Interesting, very interesting. Yeah, I'm not gonna buy this bad boy. Yeah. I mean, considering the quality of business, plus the fact that it looks murky from a debt perspective, I don't know if I'd be comfortable buying this. Okay. Yeah, no, that's a pass for me. That is a pass for me. Why did it take a while, though? Not much coverage, huh? Alright, cool. Alright, that's PRMW for you. Alright, we also have LMNR. Okay. Man, it's taking a while. God. 11:20, it's been an hour since we started. Alright, let's take a look. LMNR. Limonaria. Real estate development. Okay. All right. Limonaria. So real estate. Let's take a look at the insider buying. Is it strong? Okay, so you got some insider buying, but some selling too, huh? Alright, it's all this guy, Jose. Jose's been buying like crazy, but everybody else is selling. Okay. Sure glad I checked this out. I mean, it's a lot more potent. It's more exciting when you see more than one person buying. If it's just one person, maybe the guy's delusional, right? The guy is a director, but you never know. You gotta be careful. Plus, it's not like he's buying like crazy, you know? 12% here, 4% there. Yeah. Okay. All right. So, what do they do again? Real estate development company in the U.S. and internationally. Fresh lemons, lemon packing, avocados. Whoa, okay. All right. Grows, processes, packs and sells lemons. Okay. That's nice. Oh, really? Look at that. Wine grapes, too. You know, I want to look into that. Like, if that's a significant portion of their business, it's not going to be halal, is it? Yeah, I want to look into that. All right, Yuma County, Arizona, La Serena, Chile, avocados. The millennials going to dig that avocado. They're all about that avocado toast, by the way. I don't know what the deal is with avocado toast. I mean, I've tried it. It doesn't taste like much to me, to be honest. All right, so revenue decline. Maybe that's understandable. I don't know if COVID would have an impact on demand for lemons. Shares. Okay, so they bought back some shares. That's good. Debt to equity is 1.1. That's nice. It's not excessive. Interest coverage is negative. Okay. Negative operating margins, I suppose. Yeah. Whoa, look at that net income. This is horrible. Past 3 years, since 2019. That's not good. That is way before COVID, man. You can't blame this on COVID. That is a red flag if I've ever seen one. Operating cash. Oh, wow. No, don't tell me. Operating cash flow is negative. Okay. In 2020. Maybe that's just COVID though, right? I mean, it looks like it's peaking back up, the positive right here, almost there. So, yeah, be wary of blaming them too much for it. Yeah. I mean, it's not just necessarily just demand, right? It could be supply chain issues, just getting the produce from whatever their farm to consumers. Like, it's understandable that the COVID impact does not necessarily mean reduced demand alone. It could mean logistics issues. Yeah, that's true. All right, cool. So, operating cash flow, negative operating cash flow in 2019 and 2020, but that's just COVID, right? Yeah. All right. Yeah, and return on equity. So what on earth happened in 2019? I'd want to know what happened. What? 50 times EBITDA? 20 times? Whoa. Wow, that is expensive. Lemons. 0.8 times tangible book. Yeah, I don't know about that, man. 3 times revenue. That is ridiculous. I mean, the guys just sell lemons. Really? Why? Why is it so expensive? I just don't get it. I don't get it. Is Jose crazy? Does Jose know what he's doing? I don't know. Yeah, just for fun. I like checking out the website sometimes just to see what's going on. LMNR. Finest and freshest citrus. Whoa, over a century. These guys are old. Huh. I didn't know. Yeah. Okay. Where's my man Jose? Yeah, don't see it here. Anyway, cool. I mean, pretty website. That's nice. What do we need to know? We need to know what on earth is happening here. Also, credit assessment. I don't know how I skipped that part. So, cash over interest is 0.9. I don't like that. Interest coverage. Negative, yeah, that's kind of expected. Yeah, that's worrisome. That's worrisome. Quick ratio is 3, so that's the only redeeming factor. That's good. Yeah, I mean, maybe it's okay. Maybe it's okay. Okay. I mean, I'd say moderate credit risk, but again, like, it's not a huge amount relative to rev. Okay, it is kind of sizable compared to revenue. I mean, 100 mil, probably don't have any bonds, huh? LMNR. Nope. All right, cool. So let's see what's going on. Let's see if we can understand what on earth happened in 2019. Interview with CFO. That was back in 2019. Huh. Decline in margins from negatively impacted pricing in lemons. Yeah, doing pretty well since publication. It's beat the S&P. Yeah, okay, so acres of land growing. On June 20th, 2018, company acquired a ranch for $13 million. May 2019, joint venture. Okay, all right, so that's pretty interesting. They went in a joint venture with this company in South America, and the idea is that the southern hemisphere has kind of like the opposite seasonality versus the northern hemisphere, and so as a result, acquiring or entering this joint venture allows them to have less seasonality because they diversify, they stabilize their income. Because when it's winter in the north, it's going to be summer in the bottom, and vice versa. So 25% of the parcels of Santa Clara, 51% of Trapani Fresh. Diversifying location of its fields thanks to lemon crops from Argentina. Okay, that's a good deal. Okay, margins declined in 2019. Uncontrollable weather event. Okay, all right. Okay, all right, that's understandable. So that would explain what's going on. Uncontrollable weather events. Okay, that's understandable. Negatively affects profit margins, but the company expects 200 of those acres to bear fruit through 2021. Remaining 1,000 acres will bear fruit over the next 4 years. Okay. 1,200 acres of non-bearing lemons. Okay. Yeah, reduction in profit margins. Yeah, dividends. They're definitely going to be sacrificing some dividend. They killed it so in 2020 they cut it in half. Looks like year to date, or at least in the past 12 months, you had only 8 cents of dividends. Okay, understandable. I mean, given COVID, drop in demand. Well, demand actually picked up, but prices dropped. Also, they have non-performing assets, right? So that's going to impact. It's going to impact things too. All right, so it's been almost 15 minutes looking at this guy. What are we doing? I mean, look, I don't like the price, to be honest. To be completely honest with you here. 20 times PE? I just don't see it. 20 times PE? That's nuts. No way. I just don't see it. And you compare it to some of these other guys. Right, citrus. All right, that's a nice comp. Here, 8 times PE. 6 times EBITDA. Why on earth would I buy this guy? 50 times. Negative 52. I mean, why on earth would anyone want to buy this? I just don't see it, you know? I don't see it. 2.7 times revenue. This is 3 okay, so it's a bit more expensive in terms of revenue, but, whoa, okay, wow, Alco, not a good company. Let's pick another one. Why are they so leveraged? Crop protection, crop nutrition. Ukraine? Wow, okay. Leveraged. Why? 4.4. Okay, all right. Yeah, plus your net income is negative. Like, why are you so leveraged with such negative? What is this? S&W Seed Company, Agricultural Company. Oh my God, this is horrible. Like, forget that. Just look at it was still negative net income. I just don't see it. I don't see it, man. What is this? There's got to be something here. Okay, is there any company in the agriculture space that's actually doing all right? Wheat and soybean. Okay. Oh, dear Lord. Whoa. This is mad. Village Farms International. Bell peppers, tomatoes. Okay, all right. Thank God. Okay. Positive numbers for a change. Wow. That's amazing. Okay. Negative operating cash flow in 2019, but it went back up to positive in 2020. Okay. Debt's not too bad. You know, it's picking up, but it's not so bad. It's not terrible. Whoa. Okay. 70 times earnings? Whoa, whoa. That is pricey. Village Farms. Wait, they do cannabis too? Okay. That's interesting. Yeah, I don't know what percentage of their business is cannabis, but you're not going to be involved with that. I'll tell you right now. 70 PE. Whoa. Wow. Wow. Yeah, I mean, when you look at it that way, 20 times PE is a bargain. EBITDA, though, 50 times EBITDA. Wow. It's 53.8. Okay, so 0.8 tangible book, but 3 times revenue? How? This is 6 times revenue. 2.5 times tangible book. Wow. This is expensive. Like, no, I don't see it. Like, LMNR, we'd have to be way cheaper. I just don't see it. Jose, you're probably crazy. I'm sorry. I'm not buying. I just don't see the appeal. I just don't see it. It's going to be a fail for me. And the reason it's a fail is it's way too expensive. I mean, considering the price, 21 times PE. No, but that's not even the worst part. The worst part is 53 times EBITDA. And 2.7 times revenue. Forget about it. Forget about it. No, thank you. Not interested. Not interested at all. Okay, all right, so 4 more companies to go through. I'm kind of thinking maybe we should break for a little bit, come back later, and then do maybe the second half of the video at some point. But yeah, hope you found that helpful. And if you'd like to see more, just hit that subscribe button, and you'll get the goods as soon as they're out. Adios.